Hello everybody, welcome to a new video of stock investment. Today we are going to dedicate quite time to talk about the real estate investment sector, okay? And well, you see that in our video we say now or never. For sure you cannot say never, but it's true that can be now, okay? We are in an historic situation where the real estate investment sector is quite depressed in the market, okay? So we see that there are potential opportunities, and for the ones that like this kind of sector, they can start to have a look for taking positions for the future, okay? In the video today, we are going to dedicate the first part for trying to analyze why it is now a good investment moment. What is the investment thesis behind this comment? And secondly, we are going to go in detail in couple of specific companies, okay? For sure not to advise no one to invest or not to invest, no, but just to show, practically speaking, how to analyze a real estate investment company or a rate, okay, and for opening the door to anyone to do their own analysis and to consider if for them is interesting or not to invest. All right, so let's go on and let's see a little explanation why is this interesting. First of all, this information that we are going to see now is taken from the JP Morgan quarterly report. Okay, so in that case, is the ones that is covering until the 30th of September. So there is a couple of months more since this happened. But this is going to be good enough for us to see how is the situation. Okay. So firstly, here you see the Standard & Poor's 500 price index, okay, which is the main market. When we talk about the market in the world, we are talking about Standard & Poor's 500, and we see the evolution during the different years, okay. So here, I'm going to focus more in the last part. So you will see here, this is the pandemic, okay, where there was a drawdown of around 34%. After the pandemic, with the markets full of money and flow of money. They were going until beginning of January 2022 was the maximum in 4,000 almost 800 dollars, and this is the price to earning forward that was 21 times. Okay, so after this, in all the 2022, we have seen a relevant drawdown around 25%. Okay, so the markets were anticipating here that was going to be a crisis, okay, mainly linked to the increase of the interest rates in the US. And the minimum of the market was done in October 2022. And since that moment, we have seen an increase of the market. End of September was 4,000, almost 300. Today is in the level of 4,500, okay, something like this. And the price to earning forward was around 17 times, 18 times. Okay, now it's a bit more. Just to highlight two things. First one, that now the treasury bonds in US 10 years is around 4.6%. For the ones that they don't know what it is, that means it's a treasury bond. I mean, money that you can buy the bonds from the US government free of risk if you want, and they are giving to you 4.6% per year during 10 years. Okay. So and if you see these treasury bonds in the 20s, 22, in all the previous years was much lower, no? So for the investors, they always, this is what is called the risk-free benchmark, if you want, okay? And you need to compare the profitability that you are getting with these free risk treasury bonds, okay? So if we dedicate a little of time for assessing how is the performance of the real estate sector comparing with the SP500 and the rest of the sectors, you will see few things. Okay, here in this table, you see the different sectors: energy, material, financials, communication, technology, and real estate. Okay, and this is the weight of the sector inside the SP500. Okay, so you see, for example, that the real estate is only 2.4% of the complete sector. All right, sorry, the complete SP500, and the majority is coming from the technology sector. Okay. So let's highlight that even if the SP 500 has been up this year in 2023, 13% or more or less, the real estate is getting down, -8. Okay, so it's a big gap between this real estate sector and what the index is doing. Okay, and if we see the sector this year is getting up mainly for the technology companies, communication services, consumer discretionary, and the sector that they're not doing well is mainly real estate, also some utilities, consumer staples, and healthcare. Okay, and some interesting things additional if you compare what is the situation of the real estate sector comparing with the peak of the market in February 2020, just before the pandemic, you see that is still minus almost 17%, okay? Where the rest of the sectors has recovered very, very much comparing, all right? And also, if you compare since the lows of the market in March 2020, in the lower part of the pandemic, you see that is the sector that has recovered less than the rest. Okay, for sure there is an explanation, and we will see later why. And just for highlighting two things more, today the forward price to earning ratio is around 15 times when the average is 17. Okay, so we start to see that this is a sector that has been quite heated. Okay, during these years, and that there is a certain kind of depress, and is the multiple that they are showing now is below the ones that they have in the past. Okay. So what is the reason? What happened? No. So mainly is coming. Remember that during the pandemic there was a big amount of stimulus from the governments. They put money everywhere. Even they were in the US giving checks for free with money for people to continue spending. So that created a huge increase of the inflation, something that we all know and we all have suffered, okay, until rates of around 9-10%, which is historically high. And this forced the central banks to increase the interest rates. Okay, increase the interest rates just for trying to reduce the inflation and to put it down into the levels that they are inside the mandate. Okay, that must be around the below the 2%. Okay, so the reality is that it was a quite big increase of the inflation, and later there has been a reduction. We have seen a reduction of the inflation in the following months, okay, until now that we are here. No, so it is there is the feeling that the job is working. I mean, the inflation is starting to go in the good way, okay, but that the job is not finished yet, okay. So again, this is the evolution of the interest rates of the Federal Reserve of the United States. You have seen how was during between 2015 and 2019. Well, was a big increase of the interest rate. Later in 2020, this is the pandemic. Okay, this is the COVID-19. So they had to reduce until zero the interest rate, and in 2021 there was one of the quickest and biggest increase of the interest rates of the history. Okay, to be around the current 538. Okay, so here you see which is the expectations of the estimations of the markets and the Federal Reserves. Okay, so in all the cases, for sure, there are a little of deviations between what the Federal Reserves thinks that they are going to do, the estimation, what the market expects, and what is the long run estimation of the Federal Reserves. Okay, so the Federal Reserve, it is considered that maybe in the following 1-2 years, the interest rates can go down again until in the long term a level around 2.5%. So why is this important? It's important because when you increase the interest rates, you see this is the 10 years treasury yield, okay, and it is in September was around 4.6. Now even has been higher, okay, has been closer to the 5% in the last couple of months, all right. So this is the again what is called the risk-free yield. Okay, so the investors, if you are an investor, and maybe you are, you can select between putting your money in an interest rate at 10 years of around 4.5%, 5%, okay, or to invest in other opportunities like real estate or stocks in the market or whichever what can have more risk and maybe they don't have as much profitability. Okay, so it's a question of risk reward. So with the risk in this, with the interest rates in these levels, okay. Firstly, the investors they say, okay, for what to invest in a real estate that I can have similar returns but with risk. Okay, so this is point number one. And point number two, real estates normally they use massively debt for buying the different assets. Okay, it's one of the characteristics of the real estate sector. So as the interest rates are high, they are going to pay more for the interest of this debt. Okay, so this is creating a little of doubts in the sector from the investors. So what is the investment thesis? The investment thesis is that in the following couple of years, 2 years and a half, these interest rates that we saw before, that they are around 5%, they will go back into a level of 2.5% once the inflation is better controlled and the government or the Federal Reserve needs to give back some energy to the economy. Okay, at that moment, once you reduce the interest rate, the real estate sector will come back again as an interesting opportunity. Okay, because you will not find better opportunities in the bonds, in the treasuries, and secondly, because the debt, the interest that they will pay for for the debt will not be as much. So if we continue looking for some information about the real estate sector, okay, I think it's interesting to see how is the evolution of the vacancy rates by type of property. Okay, so here you will see in gray is the office real estate vacancy, the retails, okay, retails. Shops that they are in the malls or in the street that the companies are using for selling on the street, the apartments, residential, okay, in orange, and industrial in green, okay. Why is this important? Because in the real estate, a part of the yield that they can provide or the debt is also very important that the vacancy rates are small. Okay, because if the vacancy rates are small, and this most probably the real estate will be fully rented, okay, and they will be maximizing the return. Okay, so you might see here that after the crisis of 2008 and this turbulence period, the industrial sector has behaved quite well. Okay, so the real estate is quite covered, is quite the apartment or residential is quite stable. The retail, even if they had the problem during the pandemic, is also getting down. And there is a little of doubt in the offices, okay, especially for the work on home from home policy, okay. So there is a little of negativity also in the office sector, okay. But something that for sure you need to assess at the moment that you select certain kind of real estate investment opportunity, okay. So, something that I also consider interesting to show is the return per class asset class. Okay, so you will see that during the last years, the year 2022 and this year 2023, the year to date, the real estate are the sector that is performing worse than the rest one. Okay, so it was in 2020, in 2021 with the recovery of the pandemic was doing extremely well, but later again was depressed, and the press was the when the interest rate started to rise up. Okay, it happened something similar in 2008. Okay, with the crisis, you saw that the real estate sector got down at 37%. Okay, really depressed. But later you see how in 2009, 10, 11, 12, 13, 14 was one of the sectors that performed much better. Okay, and this normally happens because of the cyclicity of this sector. Okay, and the exposure of the real estate to the economical cycle. Okay, so now we are in the lower part, and as I was commenting to you, if finally the economy can perform as it is expected, okay, and the inflation is reduced, the interest rate will go down, and the rate sector will perform well again. Okay. And another way of checking this is the comparison between the Standard and Poor, okay, the market, okay, which is doing during that period since the pandemic more than 30%, okay, and how you see that the real estate sector, okay, which is we are using the XLRE, which is the ETF, uh, one of the most ETF used in the real estates in general, is performing very bad. So there is a big gap between what the market has done and what the real estate sector has done. All right. So just before continuing to see some specific examples of companies in this sector that can be interesting to analyze, let me tell to you that we are happy to announce in Stock Investment that we have a new investment training, okay, that is related to how to invest in the stock markets. All right. This training is what we say here is all what you need to know for investing as a professional, and especially talking about stocks, okay, how to invest in the stock markets, um, taking the experience that we have developed in the last 15 years, and using some of the resources that every professional normally use, okay. So this is the scheme that we will follow in our training, and you will see that it's like a little house, no, with some foundations and later different layers. So we have a structure like this for you to have the all the necessary knowledge, even starting almost from scratch, for being able to be a good investor. Okay, we do this because I mean we understand that there are people who are more or less educated in some of the financial tools, but we have prepared the training as you were starting from scratch. Okay, so firstly, in the pillars, we will work about the accounting and the indicators of the financial world, of the business world. So here we will check which are the financial statement, the income statement, and the balance sheet. Later, we will go to the understanding the business, and here we will talk mainly about which are the sectors to invest, which are the competitive advantages of the companies, how is the capital allocation strategies that the different companies can use, okay? Or if you are the CFO or the CEO of a company, which one, how you will do it, okay? Later, we'll talk a little about IT tools, so which are the brokers, how to select a broker depending on your situations, the information platforms where you extract the data. Okay, so once you have these pillars, we will go to one of the most important topics of the investment, which is emotions management. Okay, people think that to invest, the most important thing is to find the right stock or the right asset to invest. And trust me, after many years, the emotion management is maybe one of the cornerstone of the investment. Okay, so this is why we will talk about it here. Okay, and later we will go to the investment flow. So we will show you how to detect investment opportunities. Okay, which are the different sources that you can get all this information. How to filter. Okay, how to filter, because opportunities could be a lot, but how to filter, and we will show you how to find the 1 minute filter and the 5 minutes filter. Okay, so you can discard the 90% of the different opportunities that are coming to you just with this filter, so you don't dedicate time to what is not going to be maybe worthful for you. Okay, so once you have this small number of companies that you have filtered, we'll show you how to do the business analysis of that company, and how to do the proper valuation. Okay, how to, in this valuation, we will check which is the current intrinsic value of the company today, and what will be in the following 3-5 years. Okay, and with this you will be able to compare with the current price, what is the price that the market is offering you this opportunity, and you will need to be able to take your own decisions if you want to consider to invest in that company or not. Okay, and finally, for sure, how is the portfolio management? When to buy and how to buy, when to sell and how to sell, how to diversify properly your portfolio, etc. Okay, quite interesting. So with this, you will have all the different tools for doing the proper investment in the markets. Okay, and later, as on top, we will go to different sectors. Okay, so we'll talk about compounder companies, roll-up companies, technology and software, retail companies, financial companies, real estate. All of them are different sectors. The companies in that sectors are behaving different. Okay, so we will show you how the different sectors are different and how to invest. Okay, and the most important, and I think is interesting, in all the training we will use examples of real companies. Okay, so everything that you will learn with real numbers, real situations, real cases. Okay, we will go in detail, and I'm pretty sure after this training you will have a strong knowledge of how to put into place your investment tactics. Okay. If you ask me how it's gonna be, is the training is having 32 modules. Okay, each module has an average because there are some of them that they are longer and shorter. An average of 35 minutes. Okay, so it's quite affordable. Okay, when I say affordable, is that you can handle properly. All right, and on top of this, these modules are in a professional platform for learning because we want to maximize as much as possible the learning experience. So you will be able to access to the famous Teachable, which has is a website based, but also by phone, so you can follow your training properly in the different steps. Okay. And not only like this, but you will also receive what is our template, okay? A template for analyzing companies. So in few minutes, with the right knowledge, you will be able, including a certain kind of information and modeling the scenarios for the future, you will be able to understand what is the return on investment in the following 3 years or 5 years for each of the companies. Okay, and not only quantitative but also qualitative. Okay, and here you will have the checklist qualitative of the different things that you need to know from a company. All right, this is will be included in the training for you to later to understand. Right. So about the pricing, the template and the training, I mean the access for 1 year plus the template, this is 979 USD, okay? Which is, I mean, some people can say, well, it's not cheap. No, it's not, it's money. But trust me, if you need to select how to invest your money, it's better that you dedicate money to invest in yourself, in your knowledge, because it's what is going to prevent you to lose um, money in your investment and to learn by in the difficult way, okay, which is in the expensive way, which is spending money on this, okay, spending money because you didn't do your right investment, and not only this, but also you will lose time. No, you will take years, some years until you be able to recover, and this is the cost of opportunity. Okay. But as we are starting and we want to democratize a little or to give a little of value to the people in general, we are offering this 1 year training plus the valuation template, plus also 3 motivational books that we will see later. One for people in the 30s, one for people in the 20s, and one for children in a 50% discount. Okay, so you will have everything for 489 USDs. Okay. Uh, Trust me, once you have all this knowledge and you dedicate your time for learning, understanding, at the moment that you do small good investments, this amount will be ridiculous in what you are returning. Okay, which I'm happy. I'm happy that this is like this. Okay, and these are the 3 books that you are going to receive. Okay, it's 3 books done by us in stock investment. about the first one is 30s, not too late to succeed. Okay, so if you want to change your life from the ones that we normally have here, there is the motivation of how to do it. Or if you are a teenager and you are in this time that you are close to the 20th, so how to learn this path for the financial independence. Or if you want to start with your children at home, it's a good moment for starting to read in the nights the Smart Money for Kids. Okay, where there are the Peter's Financial Adventures. So let's go now to see some companies. Okay. So first of all, let's talk about a disclaimer. Just to remark that all the information that you are going to see now about the companies are just for educational purposes. Okay, and in any moment it's need to be considered as a financial advice. For sure, we do this for you to be aware of how to calculate the company value, which are the companies that they are there. But for sure, at the end, need to be you with a professional financial advisor, the ones who do your analysis, and the ones who is taking any risk or no risk. Okay, always take into account that investing has a financial markets risk. Okay, and you can lose all your money or part of your money in this investment, right? And every opinion that we are putting here is just our opinion, and for sure doesn't need to happen or nothing like this in the future. Okay, and again, past performance is nothing indicative that is going to happen again in the future. Okay, so we don't take any responsibility of any error, mistake, or inaccuracy that may happen here. Okay, so we encourage every participant to do their own assessment, due diligence for making their own decision. All right, very well. So let's go to the one of the most famous rates, which is called realty income. Realty income is one of the biggest rates in the market. For the ones they are not aware, no, rates is a company that normally is working in real estate, and they have the obligation of distributing the earning per share in dividends around 90% per year. All right, so they normally are using debt for buying some real estate locations and later to rent or to take incomes from this, and the benefit is just providing to the different stakeholders of the rates, right? And the good point of a rate is that you can buy and sell as if I were a normal share. Okay, this is a pure rate. So what is realty income? Realty income is the fourth largest global rate, mainly with presence in US and in Europe, in Spain, France, UK. Has been in the business for more than 54 years with a really good credit rating by the agencies, by Moody's and Standard and Poor's, around 62 billions of enterprise values, and getting annualized a rent of around 3.8 billions. Okay, so it's really a giant. It's really one of the most famous one in the sector, and there are something interesting in these rates is that they provide the dividend every month. Okay, so this is used for many people to get just recurring incomes monthly. Okay, for example, it's very common or very famous among the retired people in the US that they are investing in realty income. Okay, the diversification is high. Okay, the majority around 76%, and later we will go a little more in detail. Is coming from the non-discretionary retails. Okay, so these are small shops or shops that they're working for the large chains, all right? And later non-retail and others are around the 24%. Okay. And something also interesting, in the last 25 years, they have been increasing every every year the dividend, okay, in around 4.4%, which is something remarkable, okay? So this is one of the most famous dividends companies that you can find, all right? More information about the realty income. The total return since 1994 has been around 14%. Okay, so here is including not only the increase of the value of the stock, but also the dividends. All right, and what is called the beta respecting the Standard and Poor's 500 is 0.5. That means that every time that the Standard and Poor's 500 in average, okay, goes down 1%, this stock only get down 0.5%. Okay, so it's quite stable, low volatility. So the people that they are investing their money there, what they are looking is to have something how to say, safe or stable, and for them to receive the dividend monthly, and to see their companies to grow step by step. Okay, 26 every of 27 years of positive earning per share, and growing the adjusted fund for operation of 5%. Okay, and what is also interesting is that for them there is a huge market all over the world that they can use for continue growing in the future. Okay, it's not that they are big. Is someone can say, "Well, you're so big that you are not going to grow anymore." What they are saying is, "Yes, we can grow, and we still have plans to do it." All right. Interesting about the diversification. This is the kind of companies that they diversify. So you see that there are the top 20 clients, okay, are retail companies like Dollar Generals. If you are in US, you will know very well this company. That the small commerce everywhere for small things, a small Dollar Tree, a 7-Eleven, Walmart, Tesco. So these are the lowest. These are the kind of companies that they are really good doing their job, or CVS pharmacy. No, they are really good doing their business. So they are not a real estate agents. Say, okay, realty income, you buy the real estate, you rent to me, and I perform my business. That is what I do well. Okay, so strong diversification. Mainly property diversification. Majority is retail, later industrial, gaming, others, and in different areas. So 10% UK, and later in US, Texas, California, Florida. Okay. If we go to the company itself, we can see that the company has been growing in the last 15 years, more than 18 years, around 4% per year. But you need to add to this 4% per year in average compounded a dividend. Today, the dividend is around 5.5%. Okay, so you will see that the complete return with up and down. Okay, the complete return is always positive. It is interesting to see a few things. Firstly, and this happening in the different rates. The return on asset, return on equity, and return on investment capital is not going to be very high, okay, because you need a lot of capital in the real estate to make your business, because normally you need to buy the property for renting, right? And another thing we will see later, all the price to earning, enterprise value EBITDA, blah blah, it's not going to help you very much. Okay, this sector is measured, but with this call price comparing FFO, okay, which is funds from operations. Okay, and the funds from operation, and I will show you later, is mainly the net income and removing the amortization. Okay, so you can remove the effect of the depreciation of the assets that you are having there. All right. This is what I was commenting. This is the main metric that you need to use every time that you are studying or checking on a real estate opportunity, a rates, okay, FFO. So it's the net income plus the depreciation and amortization minus the gain of the sales, okay, in net basis, all right? It, Again, this is what is going to give you the best of the views of how the company is adding value, all right? And if we see the information from Ticker, I mean, this is what you will see here the different years. When it's finishing an A, is something that already happens, okay? And finishing in an E that is an estimated by the analyst, okay? So we can see that the FFO per share is $3, $3, $4, and it's going to be expected $4.12 in 2023. All right. And they also continue expecting that the FFO is going to continue growing the following years in this around 3-4% in average. Okay. So if you have the FFO per year, what you need to check is, okay, for example, if you want to know estimation price for 2025, so it's going to be 443, and now we need to find which is the multiple that has sense in this kind of investments. All right. So with regard to the multiple, we need to find which is a fair one. Okay, a fair one for us to do our estimation. So this is the evolution of the price per FFO per share. Okay, the multiple, and you will see I put a line here in the 16. Okay, everything below 16 is mostly undervaluated. Okay, and between 16 and 18 is the normal range from this rate. More than 18 times is probably overvaluated. Okay, so there are periods here in 2016 or before the pandemic that there was a little overvaluated. Okay, every time that you see below 16 times this rate is probably in a good multiple. Okay, so look, today is 12, almost 13 times. Okay, because of this depressed time after that we were commenting at the beginning and the situation of the interest rates. Okay, so you have all this gap that in the future, be sure at the moment that the interest rate start to get down and all the pessimism in the sector is starting to reduce and people start to focus again in the real estate. So now you have a company that is giving to you a 5.5% dividend, okay, if you buy in the current positions, in the current values, that is in 12, 13 times multiple, okay. Most probably this will go up in the future in certain moment now or in 1 year, 3 years, 4 years. It really doesn't matter. Okay. In the meanwhile, you will always be receiving this dividend, and this dividend at the end is going to be forever or more. Okay, because we see that this rate has the tendency for continue increasing the dividends. All right, and also that they have intention to grow their earning per shares. Okay, so if we were talking that in 2025 they expect an FFO of around 4.5 times. So if we do the number 4.5 multiplied by 16, so we might be around 68, 69 dollars, okay, which is much better than the return that you had today. Okay, especially remember that you not only have the return of the you need to add the dividend to the return of the stock. Okay, so this is one of the options that you have to the table. And well, as I was commenting, this is the evolution of the dividend in the last 10 years or 15 years, all right? And how this dividend per share has been evolving. Okay, so they have the policy to continue increasing this dividend over the years. All right. And the other one, the other rate that we wanted to share with you was Alexandria. Okay, Alexandria is maybe not so famous that if you compare with Realty Income, okay, that everyone knows, but it's also an interesting case that we can analyze. Okay, so Alexandria is for sure is a listed company with the ticker ARE. Okay, so if you see the evolution since 1997 to 2022, so you pass already from 300 millions market cap to 35 billions, okay, which is almost 100 times or 115 times, something like this. Revenues also incredibly high. The way what all the metrics now they have multiplied many times the value of the company during the last 25 years, right? Um, normally, what this kind of rates is doing is trying to go to the industry, okay, industry, and they have a strong exposure to the pharmaceutical sector or to the science, biotechnology, institutional, academic, all these sectors, okay, are quite strong on them. They have more than 1,000 tenants and they have locations more than 74 million square feet in the different main locations and campus of the US. Okay, so today 90% of the tenants has high investment grade, and they are public trade companies, okay, and they are publicizing this, advertising this for saying that the incomes are quite secure, and more than 80% of retention in the last 5 years. Okay, so that means that the companies are renewing and renewing. Again, this is the kind of different buildings or locations that they have. We just brought here an example. So you can see here Bristol Myers. Bristol Myers is a pharmaceutical company that they have, for example, here this big building. They have a strategical relation with Alexandria, and this is the ones that they are renting. They have these kind of agreements, and they follow on. Okay, so it's another of these kind of companies that the risk that the big pharmaceutical companies or biotechnology are left in or going away from the facility that they have is quite small. Okay, so it becomes a quite interesting option for investing. All right. Again, in the last 10 years, it's around 4.8% of growth. It was much more, but after this 2022, as we say, look, the valuation in the market has passed from, or the price in the market has been reduced from $200 per share until around 100. Okay, so it's a 50% reduction, and now is below the prices of the COVID. Okay, that was a crazy moment. Okay, so it's and it is more or less in the prices of 2016, but with a higher growth than in that times. Okay, if you see the numbers, the situation of the company, the structure of the company is quite similar to the rest of the rates. Okay, so the return on investment is normally small. Don't pay very much attention to this, to the multiples here. They have a dividends of 4.5%, which is quite interesting, and they have intention to continue growing in a more than 10% in the following couple of years. Okay, for sure they have debt, 6 times EBITDA, but this is something that in the rates is quite common. Okay. Um, Again, if you see the multiple, the situation is very similar to the ones that you saw in realty income. Okay, it happens to almost all the rates that a fair value of a multiple here must be 15 times, 16 times, something like this. Okay, is fair. Okay, it's even a little conservative, and today is in 11 times. Okay, it's in 11 times, and is because of the depression that the sector is suffering again since the beginning of 2023 for all the reasons that we've been commenting. And be sure that at the moment that all this pessimism in the market is starting to be to change, no? Due to the change in the interest rate, the multiple of the company will go back to normal values. Okay, and in the meanwhile, the company will continue providing the dividend, and they will continue to grow. No, and if we want to assess the growth, we see here today 2022 has closed in 8.42 dollars per FFO per share. Okay, so they expect to go around $10 in 2025. Okay, so we can easily say that there is a 50%. I mean, $150 in 2025. Today is around 100. There's around 50% of potential upside in the following years in this rate, plus this 5% or 4.5% per year that you can find in the stock. Okay, in the dividends. And as happened in the case of realty income, this is the increase of the dividend per share in the last year, which is also one of the main characteristic of this kind of rates. All right. All right. So I think it's enough for today. I hope that you have understood why it's a good moment today because of the situation of the economy, the situation of the inflation and the interest rates. Why it's a good moment for investing in rates. Okay. As a conclusions, just to remark that the real estate sector has been very impacted for the interest rates evolution. Okay, This will change in certain moment in the time in the future. Okay, just you need to wait, and in the meanwhile that you wait, you will always has this dividend coming to your pocket. All right. The current valuations are quite depressed. Okay, we are talking about 11 times FFO, 12 times FFO, when the fair ones is 15, 16, and sometimes can be even more, no, with the quality of the companies that we are talking. Okay, and the reduction in the future of the interest rates will bring back the multiples to more reasonable ones. Okay, so the sector will stop to be depressed to be something more. When is going to happen? I would like to have the crystal ball. I don't have it. Okay, but for sure is a quite a strong possibility. Okay, so if you want a recommendation, if in any moment you are looking into the real estate sector and the rates, always try to look for companies that they have a strong track record. Okay, of many years of performing well with a management that is well a good reputation, okay, and that they have a lot of skin in the game, okay, that they have already a lot of shares, so you will be sure that they are trying to add value to the business, all right, and later that the customers that they have are well diversified, and they are able to continue paying the rates and the vacancies rate are not so small, okay. So, well, I hope you like the video. We are going to stop for today. Thank you very much and see you next time.